Hey everybody, this is Jose. How are you, my friends? We are about to get started. This is a sound check, as we always do before we start the session. Please, quick message on the chat box, please, so I know you hear me well and that we are all ready to get started. Yourself, myself, and also the technology. Please let me know. How are you, Jeff? It's good to see you, my friend. Very nice. Okay, so we got 30 seconds to go, a little less than that, and we are going to be on our way. Looking at our options markets and our trades and opportunities and everything else. How are you, Joe? Good to see you. Very nice. Very good. Thank you, guys. 5 seconds. Almost there. Here we go. We just made it. Top of the hour. Options with options. Welcome to the session, everybody. This is Jose Blasco, March 24, 2022. I guess the name of the session says it all. We're going to be looking at the options markets and looking at market opportunities, at how to use options in a proper way, at how to set up our trades, at how to adjust positions, manage the trades, etc., etc. Before we get started, disclaimer on the upper left side of the screen. As always, please read it carefully. I think it's, as I always say, fairly short. Therefore, I am counting on you to read it completely, since it is, as I said, important. So please read it carefully, okay? Cool. Agenda for today, current market environment. We're going to do our analysis. We're going to be looking at the trades that we have. We're going to talk about if any management action should be put in place. And from there, we'll be looking at new market opportunities. How are you, Mark? Good to see you. Very nice. Perfect. That's the plan. We have our question page. Let me highlight the URL in case you don't know it. It's tradewithufos.com/Jose. When you come in here, you have the question page. By the way, the first question on the top, it's related to stock tweets. So I would like to make a comment about this in a moment. And again, the importance of this page is basically when you have questions, okay, you could certainly shoot an email to us, but then normally there is a little bit of waiting time before you get your answers. So often I'm pretty positive that good answers are being found out of prior questions that have been posted. So the idea would be that when you have questions, come here, search, you may get your answer waiting for you, and if not, then post the question here so you get the answer, but also you are helping the community on, basically helping other traders to get their answers sooner in the future. Okay, so this is the importance of the question page. Talking about the stock tweets page, Christian had a post that was not working easily for him. There was some sort of an email validation, something like that, that was making the process to be relatively difficult. And also, I've been monitoring that page, and I've seen that there's not been too much activity. So I would say that, please correct me if I'm wrong, but I would say that it's not looking like it's been your favorite page ever to utilize as a forum to, have communications and conversations running related to trading, and more specifically options trading. And therefore, what I have concluded is that I need to be looking for a different type of tool, ideally embedded on our website, that could make your life a bit easier, especially as you know, we are in the process of launching a new site. And when that is done, ideally the functionality would be there instead of stock tweets, which seems to be not your favorite. So if I read you well as a group, and you are with me on what I said, please confirm on the chat box if you can. If I didn't read you well and you happen to love stock tweets and there is something that maybe we haven't got right, so please share as well. And if you prefer to send an email for that, I would also take that, okay? Let me know when you can. In any case, time to do a little bit of market analysis. So we're going to be starting looking at SPY, as we always do, and begin our market analysis, okay? So it's been a long time that we didn't have a thick blue dot on the S&P, isn't it? Well, it seems that we are in an up confirmed climate, which is something that has not happened for a long time, okay? So we are in this confirmed up climate. This is thick and blue. Now, the note of caution in this case is that we have reached number 7, when the statistical normal direction of a climate to the upside would be 6. So in other words, that climate starts stretching a little bit. Again, It's not a major concern, especially, we see many times that the climate stretch a little bit more. The maximum distance for an up climate is 0.77, and in this case the maximum distance has been reached of 129. So that is a little bit of a concern, meaning that in this movement to the upside, especially on that particular day, that's the day that basically the climate overextended. So we have seen moves. Not only we're now starting today, we are surpassing the normal direction of the climate, but we've seen moves that could be defined, statistically speaking, as too far too fast. Okay, and that is often the definition of a non-sustainable market condition. So from there, my expectation now would be a climate to the downside. Again, not a big deal. That would be a 3-day on the way down. So it's not the end of the world. And from there, probably a much healthier scenario to get into long trades. But finally, after a long fight for the market for a very long time, it seems that finally the market is taking some sort of a decision when it comes to going back up. Okay, so something to watch. And again, opportunities to go long seem to be around the corner. Now, the reason why my comments are quite positive here today is because look at what just happened on the 3-day average of the implied volatility of calls and puts. We just got a crossover, meaning that there is more call buying versus core selling. Again, given the duration of the climate, I would expect a pullback into a red climate for a few days, and then back to blue, and then that would be really the time where getting long would be more interesting. So again, the last time that we had a serious crossover was here, when the market was crashing very heavily, and then the puts started winning. Then it's been a lot of indecision during all this time, which we could see with the climate here, where the climate would be blue, but then the puts would be up above, the gray line above the blue line. Then we had a little bit of a teaser here, where for a little moment in time, we had more calls than puts kicking in, but that was in the context of a red climate, where this is now happening in the context of a blue climate. Hence, the very positive words I had when it comes to my expectation for the S&P compared to before. Okay, so again, it's looking like the S&P wants to show the world is going to go up. But again, from a statistical point of view, probably a little correction is to be expected at any moment before we see that consistent move to the upside again, as we've seen many times in the past. Okay, from a UFO point of view, we are starting an Elliott wave, so it may need to rally to the red UFO before it falls, before it gives us that red climate. So that could be, but also nice to see that we got UFOs below. That UFO, for example, is lining up with the EMA, and then the one below as well. So again, I would be expecting, given the fact that we just started a wave and there is no any UFO close by, that the S&P will rally maybe for another 1-2 days, reach that higher UFO coinciding with the end of a wave, and then create a more serious correction all the way to this UFO, and from there a new blue climate would begin. That kind of expectation. Okay, and again, of course, I cannot predict the future, but the reason why I'm doing these drawings is just to make sure that no one gets in greedy mode, building too many positions now, because finally we got a confirmed blue climate. Again, it's probably more time for some profit taking if it rallies a bit more than entering to the long side, and definitely no time to go short yet because the climate is blue and confirmed. So no time to go short either. Okay, so from that angle, we talked about it from the implied volatility point of view. If we look at the VIX, obviously we all know the VIX is now down to 22, so it's not like it's super low, but definitely compared to what we've had for a long time is quite low. So my choice for today, as we are done with reviewing the trades and so on, my choice for today is going to be to build double calendars, because the market direction is not clearly defined. So I want to position myself as a non-directional trader, but at the same time, because volatility is lower, so I would like to find candidates where earnings are reported sometime from now, so I can ride the increase of volatility now that the VIX went down, while we give the market the opportunity to do whatever it wants in a wide range, as the climate redefines itself, and then we can add more directional positions. Okay, so that would be the plan. Take advantage of time passing, take advantage of increasing volatility while we wait for that, red climate back to blue climate, and then get back to longs, or red climate get back to shorts. Mark, I would like to be able to meet with others live at an agreed upon time. Okay, so really what you're looking for, Mark, it's more than like a place where to post. It's more like, like a meeting room or something like that. I believe that's what you're saying. That's what I'm reading. So got you. And again, we'll be looking for a solution for that. Okay, just give us a little bit of time, and we'll be on top of that. Speaking about that data disparities, how many bars do you have referenced in the 55-minute chart? Yes, I know. And by the way, I'm going to answer that question right now. But when it comes to data disparities, so keep in mind two things: that depending if you're using the TradeStation data feed or the QC data feed, there may be data disparities. But also keep in mind, which I know is not perfectly ideal, but is what it is. Keep in mind that since we are always developing and working on new possibilities and improvements of top, that there are many times where I run versions which are not the same version you have, and sometimes my version may be buggy. Sometimes my version may need a clearing because it's a test version, so maybe I need to clear certain things that I don't. And it seems that especially when I load the volume page here, maybe this is a good time to do it now, Mark, just to bring a little bit of peace of mind to everybody. So it would be good to know if you could confirm on the chat box if your figures are the same or different. And after you confirm, I'll do something, and then we can reconfirm if the figures are the same or different. Okay, so we could do that if you don't mind. And we have a little bit of delay with the video feed, so I'll be patient here on this screen, so I give you time to double check and to respond on the chat box. Okay, but again, how are you, Ahmed? Good to see you, my friend. But again, the data is the data. Okay, so you should be fairly confident at that. And it's not like what shows on my screen is the data. Okay, what probably is the data is what shows on your screen. I am probably the one running more of the evaluation versions of top than everyone else, because you guys have the every time there is an update, you guys have the final versions. Okay, so good. Okay, so your numbers are slightly different. Okay, so take a look at it. If I change to another time frame and I come back and these reloads, okay, so now I would say we are likely going to be much more similar, or now we're going to be the same. Okay, and let me know if that's the case or not. Okay, now that I changed from one time frame to another. Again, sometimes my page files, because I run from version to version, my page files are not updating the way your page files would be working. Okay, so after I have changed time frame, because I see your comments on the chat box, which may be from a few seconds ago, so reset those comments, please. So since I changed to the weekly time frame and back to the daily time frame, do you have same or different results? And also, are you using QC or are you using TradeStation? Okay, so I'd love you guys to type same, different, QC, TS. Okay, that would be great if you could type two words, same or different, TS or QC. Okay, that would be great. So now I know exactly how to interpret what you just shared on the screen. Okay, and by the way, talking about updates, we will have an update pushed out. I mentioned that last Thursday. That would be somewhere beginning of the week. We have just a little bit of delay, but it's going to be, I would say, 1 to 3 day maximum. It's going to be the time. Okay. Okay, so you have 33.3 and 28.5 on the day graphic. Okay, and did you guys also change weekly and back to daily? And also, Joe, I read you that you have different. Both Mark and you, Joe, are using TradeStation. I'm using QC right now. Yeah, Joe, no new features in the update. It's basically improvements, especially with the risk graph and some stability issues with certain type of graphic cards, and just improvements more than additions. Okay, that's what's gonna be available. That's really the main focus at the moment, to make sure that all is fine and fine. Okay, so again, I'm just gonna update one more time quickly, and back to daily. Okay, Here we go. Those are the figures. Did not change the numbers. Okay, got you. Yeah, I would expect for you to not to change too much, but for me, it would, because again, because of all the various type of versions that I have on my end. Okay, got you. Um, Now they're the same. Yeah, I got you, guys. I'm very positive that what you see on your screen is what it is. Actually, uh, I use multiple computer screens, multiple computers as well, etc. And again, this computer I'm using normally to deliver the lessons. I do a lot of testing with this computer, and again, I'm pretty positive you are fine. If you were to see a disparity which is like crazy, so it'd be good that you could document that for me, and for sure we'll look into it as much as needed. Happy to even meet with you one-on-one and we can do tests together, whatever that is. I'm committed to make sure that what you have on the screen is what it needs to be. But we have done so much tests before that I'm so positive that's the case. Okay, and that I'm not really concerned unless you have a concern and you want to share that with me. I'm happy to comment. Okay, good, very good, everybody. Thanks for that. Yeah, and curious to know, Joe, if after you change time frame to weekly and then back to daily, it's just like Mark, now you have the same values as me, or maybe not. Let me know if that's the case. Okay, let's begin, guys. The rest of the session. Okay, I'd like to go over more things. So positions. Okay, so we have a trade here with Caterpillar. This is an iron condor. This iron condor expires tomorrow on March 25. So we are really reaching the end of the life of this trade. This trade had $33 of credit. Still different in your case, Joe. Okay. So let me do that in parallel. I'm just going to be working in parallel here. I'm going to be loading the TradeStation version of top as well. And then I will bring it in the screen before the end of the session. If I forget, remind me, please, Joe. So then we can run again a comparison all together and make sure we have what we need to have. Okay. Yes, and back to the bars. Yes, I forgot that one, Mark. So I am looking at in the 55-minute time frame, which is the one I have right now. If I look at format, okay, I got 1,000 bars at this moment in time. Okay, this is what I have at this moment in time. And by the way, this changes depending. Sometimes I'm planning a trade and I need to load more bars or less. And then when it comes to the study, auto UFOs and the calibration, I'm using 61.8. And this is currently giving me 49.12. Okay, so of course, if you change the amount of bars or the calibration, that would have a direct impact on the number. And also in this case, no matter how much you refresh or you don't, in this case, the data will be very dependent on the data source. Okay, so with TradeStation or QC, you will have, even with the same amount of bars, you would have a difference. Okay, I'm pretty positive because the way the information is plotted on the screen is different. And by the way, one more thing as well that would add to the difference is if inside format you have selected show all sessions or you haven't, this would also generate a different value here on the upper side of the screen. Again, the goal should be that you find values and calibration settings that are in line with your preferences and trading plan. We discussed calibration in the past. I guess that's very clear. If not, let me know. Happy to talk about calibration in a sharpening session, for example. But the idea is that you calibrate it in a way that makes you happy, and then you don't have to worry again. Okay, so it doesn't need to be exactly the same. 45.65. Again, I wouldn't be surprised about that. Okay, let's do it. So if I open a chart, this is TradeStation, fresh chart on TradeStation. Let me remove everything, remove all studies. Okay, let's add the auto UFOs with 61.8. Here we go. Let's move to SPY. Let's make it 55-minute time frame, and let's move to format 1,000 bars. Okay, and don't show all sessions. So if we do that, okay, I got 45.45. which I think that is very close and very acceptable compared to what you get, Mark. Okay, and the difference, that 0.20 difference, is probably due to the fact that I'm in Asia, so TradeStation doesn't have servers in Asia. So for the data to come here, probably there is some data loss or something like that because they don't have servers in the region, and that very few minor losses create losses of data, create a very small difference. Okay, so I believe that's what it is. Okay, now if I go back to the daily time frame, let me load open page. Let me load options with options so I can get. You see, it's taking time for this to react, and the reason is because it's the transition has no servers locally in Asia. That's why I'm always using QC here. Okay, so let's load SPY. Now, as this is loaded, okay, you can see it's not loading too fast, isn't it? Okay, so let me do this weekly, just to replicate what I've done before, weekly, daily. So I say I would do that at the end of the session. In the end, I'm doing it now. Let's go back to QC, and I'm doing the same, weekly, daily. Okay, and it's loading, 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 loading. So I got 34K, 34.1, okay, and 1 on the put side. And with TradeStation, I got 34.1, 34.1, and 1 on the put side. So I would say it looks fairly similar, if not totally similar. And again, that's the most I can do to show on the screen. And again, there may be tiny differences which are caused by network delays and things like that, but I would say very little should be the case. Okay, so 330, I got 35.9, 33.8, 35.9, 33.8, 1.3 on the call side, 1.4 on the call side here with a TradeStation version with a QC 1.3. And if I update loading. Okay, just one moment. Okay, so 1.3, 34.9, 33.8, 1.3, 34.9, 33.8, 1.4. Okay, so slightly differences. Okay, slightly differences. Yeah, which are related with data feed and stuff like that. Okay, yeah. So again, it's data that can be trusted. Okay, and also, by the way, the volume map is not something that you use to trade intraday, isn't it? So it's not, you're not going to apply it to a 5-minute time frame. This is normally something that, like, thank you, Ahmed, for confirming that as well. This is great. I mean, I think it's a healthy exercise that we are doing. We need to jump into trades now, okay? But again, trading is all about confidence. So I guess this is a healthy exercise in the sense of bringing in some confidence. Keep in mind as well that the volume map is a tool to be consulted, way in the middle of the session or at the end of the session, or maybe if you're going to use it right at the open, you do it based on the data from the prior session by dragging these or something like that. Or if you are doing some sort of a longer term type of planning, and maybe you're looking at key turning points and you're looking at, what happened on that day, whatever, and this, you translate the information to a weekly time frame and things like that. So, I mean, you could use it in many ways, but nothing is that time sensitive that generate a concern on my end where I know you guys are going to be using data which is not accurate. Absolutely not. We've done so much testing which proves otherwise. So I think that you are fine. Okay, you are fine. Having said that, there may be a time where there is some market delay, market issue with the data feed, the page file gets corrupted and you need to create a new page. Something got, something is weird in the computer, something. So for sure, when in doubt, contact with us, guys, like you have done before, and we're here to help. Okay, but at the same time, I don't think there is anything that could be seen as a problem or an issue which should generate any problem of any sort for you guys. Okay, so I think we are good to go. If there is any remaining concern about that, please speak up. I'm here to help. And as I said, happy to get one-on-one if needed, to make sure I understand what's happening on your end and how I can help better with the technical team as well to bring in whatever it is that can help you better. Okay, let me know, please. Don't be shy. Either now on the chat box, if you want to send me an email separately, do that too. Anything, guys. Okay. Yeah. Very good. Very good. And Joe and Mark, in the meantime, while we get Joe and Mark and everyone, okay, while we are waiting to put together, the new website and tools and everything else, um, feel free on the chat box now here. Remember, this is a closed room, okay? It's only between us. Will not be published in a public stream on YouTube or anything like that. If you want to share your emails or anything like that, so you get in touch and you get trading together and so on, do it, okay? Don't, we are not allowed by law for me to take Mark email and send it to you, Joe, or vice versa. That by law, that would break privacy law. But between the two of you on the chat box now, you can for sure share contact information and get in touch and go for it, my friends. Okay, it's all about community, guys. Back to trading. Okay, so positions. We are talking about Caterpillar, which is an iron condor trade, which added 35 cents of credit per contract, which expires tomorrow. And to be honest, I'm going to keep this review very, very short, based on probabilities and the probability scone. So the price should end up either here or here tomorrow at the close. Okay. Currently, the price of that stock is here at 223 something. All of it is inside the purple zone. So it's looking like this trade is good. Again, we will know for sure tomorrow. Next week, when I'm back with you guys, I will certainly review and confirm what happened at the end. Sometimes stocks go absolutely crazy in one day, and next thing you know, now we end up outside the zone, and that would be obviously a problem. And it's happened before, so it could happen. But from a probability point of view, you have UFOs to defend yourself. The probability cone suggests price is going to stay in the range. Should be fine. Okay. So nothing to add, nothing to comment, no management. The only thing I will add is a question for you guys. Any question about Caterpillar? If no, please type no questions. So I know there are no questions, and that way I can move on and begin the planning of the trades for today, which we got 30 minutes of time, 35 minutes of time, and I would like today, ideally, more than one. I'd like to be a bit more, let's call it greedy. Not the right word to use for traders, but I'll use it as a joke. Okay, let's be greedy today, and let's shoot for 2 trades in 35 minutes. Let's see if we can do that. Okay. Good. No trade, no questions on Caterpillar. Mark, thank you so much. So I'm going to load the matrix here, so we can start looking for opportunities, which are ideal scenarios for double calendars. Okay. The last double calendar we did was WMP, if I'm not mistaken. I think it was a good experience where we had a little bit of everything happening on the trade. The management was kind of normal, and the trade ended up with a nice profit of $100+ per contract, I believe. So the idea is to try to replicate the same type of opportunities. As I do it, please remind me or let me know on the chat box if you want me to rephrase the whole rationale behind why we do double calendars and what is it that I'm looking for, or you just want me to build a trade and that's it because you remember because the last one is fresh. Let me know. Okay. Do you want me to review the rationale behind a double calendar, or you want me to just build it? Okay. So on the chat box, review or build it. Okay. Sip of water and I'm with you. Okay, good. So I'll start putting the parameters on the matrix while I'm going to be watching the chat box. And again, super appreciate it, guys, that you guys are back and forth with me, engaged and interacting. It makes such a big difference on my end. Okay, so the first thing I want to do here is to look for options that are low price. I'm going to start with technique number 1. As you probably remember very well, is looking for continuous implied volatility mean to be below the 20%. So that's going to give us a list of underpriced options. For me, build it. Very good, Joe. So I'll just do that. Unless someone is asking for a bit more detail, I'm just going to go for it, okay? So low implied volatility, okay? That's what I'm looking for. Then on the stock filter, nothing is checked. I'm happy to take anything. I don't care about sector rotation or anything like that. Scan list, as always, I'll import my list. Okay. Strength, of course, a double calendar. Well, as you saw on the last trade, if the double calendar picks up direction, we could actually make a lot of money. But we want to start with a scenario where neutral is better. So daily neutral, weekly neutral when it comes to the thumb strength. Earnings, okay, so earnings, we don't want to exclude earnings. Actually, we plan to make money on the rise of implied volatility as earnings are approaching. We just don't want earnings to be too close, right? So it gives us the opportunity to sell at least a couple of weekly expiration options, something like that, to lock in some theta profitability. So I'm gonna say next than 15 days is good. Okay, so we can do that for the next avoid earnings that are 15 days closer from now. Stock price range, we could play with that, but no need. And auto climate also no need. Okay, so if I scan with all of those parameters, we end up with a list of 6 stocks. Okay, where earnings are April 26, April 18, April 28, and then we fall into May. Today is March 24. So we are talking about a little less than a month to a little more than a month. Okay, this is the type of options that we got there. So let's start. I'm going to start looking at IBM. Okay, I'm going to start looking at IBM, and here's what I'm going to do. I'm looking at IBM. The amount of data I got on the screen here, okay, goes from December all the way to now. So this is kind of like a quarter, and you can see that on the earning date we had such a beautiful peak. I'd like to see 2 or 3 earnings dates. Okay, so that one beautiful peak and drop, that one interesting peak and then drop. So nice rise, which is what I'm looking for, and here major rise. Okay, so good reactions to earnings for IBM. Not that I didn't know that, not that you probably don't know. Okay, but I just wanted to show you visually speaking, because maybe you're looking at for example AT&T, T-Mobile, and when you look at the earnings, okay, so you can also see the rise is very clear. You can also see the rise is very clear. You can also see the rise is very clear, where other stocks may not give you such a clear pattern of such an exaggerated rise. It may rise, but not that much. And by the way, AT&T, to be honest, here, if you look at from here, that's 29 all the way to here, that's 18. That's not bad, but in the other earnings report, this is 28, and the bottom, it's kind of 20, so it's like 8%. Okay, if you look at IBM, instead of 8% drop, so we are talking about from here, that's 32 to the bottom here, it's 16. Okay, so 16 to 32 is double, is 16. Here we got the top is 28, the bottom is 16, so 16 to 28, pretty nice rise. And here, well, I guess this is a special case, going all the way to 50, that's not a normal thing, but you can see how IBM got more spice in it when it comes to catching a rise in implied volatility. So again, when the list is very short, okay, and let's say you want to add 1 or 2 positions maximum to your account, so it's worth it to go one stock at a time. Apart from liquidity conditions, where we know IBM is pretty okay with liquidity, SRPT, I believe, is not that good with liquidity, even though I could be wrong. So again, looking for liquidity so you get hurt little on slippage, and looking for nice rises into earnings so we can benefit more from an increase of volatility. That's one way on how to do a selection in this list. Okay, for now I'm going to start with IBM. It's kind of like a safe bet when it comes to liquidity, option strikes, things like that. It's normally pretty okay, so I'm going to start there. Okay, let me see. EWTP neutral, yes. So again, a double calendar is a non-directional strategy. So I want my parameters to be neutral, just like if I was to build an iron condor. The only difference is that instead of looking at high volatility options, high overpriced options, so I can sell them, which is a condor, I'm looking at cheap options, so I can buy them. Okay, I can buy them and play with that. Okay, and play with the rise of into earnings. Okay, so now we know earnings on that particular stock are happening on 4/18. Typically, when you do an iron condor, you will want to use the expiration date before, which is the the one where you are out prior to earnings, so you avoid any issue. Well, here we don't want that. We want the opposite. We want to benefit from the rise on the implied volatility, and therefore the expiration date to be used to buy options are going to be April 22nd. Okay, so April 22nd is for sure. Okay, for sure. Let me bring in a chain with IBM. So April 22nd is for sure an expiration date that we are going to use. And just to be visual, if I use the skew tool on IBM and we look at April 22nd, so you can see how April 22nd is up here, okay? Probably because already we got some of the earnings effects being built in, okay? So now if I add April 1st, okay? So notice that depending on the strikes and depending if it's puts or calls, so I want to compare April 22nd, okay, with April 1st. And yeah, so already you can see that plenty of volatility is going into the earnings date, which is in line with earnings. Okay, so to be honest, I would prefer the red line to be closer to the pink or even ideally above the pink line, meaning that I'm going to collect plenty of implied volatility on the front wick. In prior sessions, I called that an arbitrage opportunity, even though it's not, because you will never get as much premium from the front wick versus a longer expiration option. But from an implied volatility point of view, it's kind of like yes. So then I really like that because it puts you at a great advantage in case the stock starts rallying or dropping or falling very hard right at the beginning of the trade. Because you collected so much premium from the front wick, it's giving you a great advantage. I'm not having that here. Okay, I am not having that here, and I'm not too happy about that. Okay, so because we got time and I don't need to rush today, so here's what I'm gonna do. I'm gonna move this to blue color. Okay, so I can have it all linked. So this is my option chain, this is my options queue, and because I had other opportunities, again, if you have the longer the list, the more you have to choose from, because normally those trades are not trades that you want to do like 5 trades like that intraday, right? So those are trades for a month. So you may have 1, 2, 5 in your account, so you add them one at a time if you wish. So I would like to check other opportunities, for example, G. Okay, so G is having earnings in here, so the expiration date to use would be 4/29. So if I look at G and I look at 4/29, which is blue, I believe this is giving me what I want. But let me confirm the data loads, which is taking a while for whatever reason. Okay, it's taking a while. Come on, the put data is not loading. Not sure why, but yeah, and that 400% volatility that is yeah, something is not loading well here. Give me a second. IBM G. Okay, now it loaded. Not sure what happened. But anyways, you see, this is kind of like what I'm looking for. Okay, so the April 29, okay, is trading at volatility levels of, let's call it 35. Okay, well, at the same strike, the front wick is trading at volatility levels 34. So it's almost the same. Ideally, the red is above the blue. Some strikes are, so we may be okay. Okay, we may be okay because some strikes are, as you can see. Okay, like if you use the 90 strike, so the red volatility is like 39, which is the front wick, where the blue volatility, which is April 29, is 36. So again, you are buying options with 36 volatility, you are selling options with 39 volatility. That's the kind of arbitrage opportunity I'm talking about. Okay, so we have a better scenario here with G versus IBM. Okay, so let me take a look at the option chain on G, and maybe we're gonna do it on G instead of IBM because of that reason. So liquidity for April 29 is okay, 405, 425, 4380. So this is indeed tradable. Not too much volume coming in on the put side, a bit more on the call side, not the largest values in the world, but it's okay. And if I look at April 1st, which is the front wick, we're also dealing with bid and ask 180 something, 170, 160. So yeah, so this is indeed tradable. Okay, so because liquidity is okay, and because we have a better advantage with the implied volatility, okay, we almost have that pseudo arbitrage opportunity, right? So then I'm happy to do a bit more analysis here and find our opportunity. Okay, so when looking at our opportunity, what I'm going to do is look at the earnings date, okay, and draw my range, okay, from here to the current date. Like if I was to do an Aaron Condor, even though the management of the trade is totally different, as you may recall, because we don't need the stock to stay in the range to profit in this case. Okay, we don't need the stock to stay in the range to profit. It's a different animal. So this is the statistical range. Now I want to drop to my 55-minute time frame to find out where are the UFOs, what's the probability, again, because I do want the stock to be in the range at least for a while, so I can collect those weeklies and therefore make the trade risk free. And then, of course, in a perfect world, it would break out of the range, but not before I made the trade to be risk free by selling from wick. So, look, do we have multiple UFOs above and below? Yes. Probability is 56%, which is more than 48, so we're good. So my upper range would be located right here. Okay, that's where the upper range would be, the purple line. So I'm okay with that. Okay, and then if I look at the bottom part, so it looks like I need to load more data to get more UFOs below. Could have looked at a larger timer frame chart to find out how much more data, but you know what? Let's load 10,000 bars, and that's it. Take a sip of water. Okay, so what do we, nothing. Okay, so let me take a look at the daily time frame. And so how much further? Oh wow, we need to go very, very far in time. Okay, very, very far in time, all the way to somewhere like November 2020. That's pretty far. Okay, but you know what? Again, this is not critical like an Iron Condor. So I got 58% on the daily time frame. I also got 50 plus percent on the 55-minute time frame. So worst case, I'm going to try to do better than this, okay? But worst case, let's say I was not to find any UFO in the intraday time frames that are located beyond the red line. Guess what? I could use this one, and it's fine, right? Because in the end, what I'm looking to define a range where UFOs are, where now I can break it into three pieces. That's what I'm looking to do. Okay. So of course, I'm gonna try to find UFOs on an intraday time frame, but worst case, that would work. Okay, because again, this is not a trade where you need the price to stay in a specific range for you to profit. That is only true during a certain period of time, and it's almost a guarantee that the weekly expiration options will expire and will sell new expiration options every week. You know, each time we are hitting or getting close to one of those dotted lines. So many weekly expiration dates sold against the main units that we buy today are going to make the trade very low risk, or ideally, in many cases, risk free. And therefore, being very flexible with the width of the range, it's fine. We don't need to be so fine as an Iron Condor, okay? So 55-minute time frame was not giving me UFOs below. I'm going to try 89. Come on, come on. Okay. It's taking a while. I'm not surprised. I got loaded 10,000 bars. So it's going to take a while. Okay, we have it. So no UFOs below. So if it's not 89, I'm going to try 144. Okay, so 144. Let's see. No. And then I'm going to try 233. And if it's not, then I'm just going to use the daily, and that's it. Okay, almost there. Come on, come on. My goal is to do two of those. Okay, so no, we don't. Okay, we don't have. So I guess that there may be some sort of a gap or something like that. So again, the most accurate way to do it would then be to use the daily time frame. Nothing wrong as well with using the 2-day time frame to see if there is anything there, or the 3-day time frame. So if I was to use the 2-day time frame, this would be the location of my purple line. If I use the 3D, same. If I use the 1-day, it's a little higher actually. Okay, so I'm gonna go with that one. That's it. So this is gonna be the location of my range. Okay, so now that I know what's the location of my range, I know the range goes from 108.65. Okay, so 108.65 to 75.97. Okay, what did I say? 75.97. I said right? Yeah, something like that. So 75.97. Okay, so the range, the whole range is $32. Okay, and then what I want to do is I want to break that into 3 pieces, which is like $10, $11. Okay, so $10, $11 below my upper portion here, which is 108.76. Okay, is around $97, $98, something like that. Okay, so I'm just gonna wait. I'm just gonna type something like 98. Okay, something like that, 98. And then the bottom part, if I take the bottom part, which was 75, 90 something, let's call it 76, and I add my $10 something, so this is bringing it up to 96 something, which is somewhere here. Okay, so 86, I think I said. So 86 is more or less here. Okay, so now I don't need to be too precise here. Okay, because now we are depending on what's available on the option chain. Okay, so on the option chain, okay, we are looking for strikes which are in line with 98 and 86, the nearest we can. Okay, so 86, 87, 80, do 86, 87, and then we'll do 98, 97, something like that. So let's see what's available. Okay, and let's expand this, and we can see. Okay, data is loading. I guess my connection is a bit slow today, I guess. So we can see that on top we have the 8 days to expiration, April 1st option, and below we have the April 29th, 36 days to expiration, and we can see how we have 86, 87 in both cases, we have 86, 87 in both cases, and we have 97, 98 in both cases, and we have 97, 98 in both cases. Okay, so we are fine. We have all the strikes we need, okay, no matter the expiration date. Okay, so we can actually be picky. Okay, and we got the 97 and got more volume than the 98 on the call side. Okay, but on the front week it's the 98 a bit more. Spread 60 to 67, 41, 43, 270 to 84, 220 to 20 to 46. So we're gonna try both, and then the 86. Kind of like not too much volume here, and here not too much volume, but the spreads are reasonable everywhere. So let's do this. I'm gonna build the 98 first, and then we'll try a different to see which one is best. So we got 98 call and sell the 98 call using the front wick, and then on the put side I'm going to be selling the 86, and I'm going to be buying the 86. Okay, so this is the trade I'm building. So I'm going to graph it. Let me re-explain all of this. So this is your double calendar, and again, when you see it like that, you're like, oh, what kind of trade is this? No worries. When volatility rises, look what happens, isn't it? So we saw this before. When volatility rises, now we have a very wide profitable range, isn't it? So again, we're gonna play that. Okay, we're gonna play that. So what is it that we have? Okay, so we are using 98's calls, buy and sell, buy 29, sell April 1st. We are using 86 put, buy and sell, buy 29 of April, sell 1st of April. Okay, that's your double calendar. Okay, now I want to compare that with what if instead of 98, I do 97, because again, we don't need to be that precise. And what if instead of 97, what if instead of 86, I do 87? Okay, I want to see if there is any significant difference. Okay, so the one on top is giving me a risk of 323, the one in the middle 340, the one below 333. So it actually looks like the 9886 is the best choice from a risk point of view, because that's a debit, meaning that the amount of money you pay, that 323 is what you pay, and therefore that's the risk you get. Okay. At the same time, there is something I'm not too happy, which is if I sell the 86 put and I get paid 17 cents, and then I have to roll it, because we're gonna roll it once a week. So that may be very little premium. Okay, anywhere under anything like under 20 cents or something like that starts being like very, very small. I mean, it's okay if that's the only thing available, I'll take it. But maybe I'd be inclined to do 87, because 87 is gonna pay me 24, which is just a little extra. Okay, and yeah, and it increases the risk of the trade overall by 333 instead of 322. But at least when I start rolling, I'm gonna have just a little bit of a tinier advantage. So I'm kind of inclined to like this one a little better. Now, from a break point of view, what's the Vega exposure? 14. It's basically the same as here. And the theta, 3 cents. Here is 4 cents. So you see, we have just a little bit extra theta because we got just a little bit extra premium. So I'm kind of happy to see that. The Vega is the same. The theta is a bit more. And, if volatility rises, so notice how the purple line is going slightly above the blue line, which, justifies that you're just paying just a little extra. So this is kind of like the one I'm liking the most, using the 87 instead of the 86. Even though using the 86 would indeed not be wrong, it seems to me the 87 is just a little better. So this is the trade we're going to do. Okay, notice that if that stock goes down below 84, okay, you would start losing money. Okay, but for the stock to go below 84 based on historic volatility, you will need to reach the date of April 14, which means that you would have sold 1 and 2 more of the front week, meaning that at that stage, the risk of the trade may be very, very small, or maybe there is no risk anymore. And in the meantime, earnings are approaching, right? And as the earnings are approaching here, okay, so if we take this case as an example, okay, well, here volatility didn't go too high, so that's a great example. So it went from 27 to 36. So this is like, let's call it 9%, let's call it 8% increase of volatility. So if instead of the current level of 36, we go like 8 more, which 36 and 8, that is 44. So notice now the break-even point would be just a bit lower, but with those 2 or 3 additional rolls with the weekly, so really this trade improves through time, as you probably remember. Okay, so I wanted to bring that to you again so you remember the case. Again, worst case, if the stock was to drop to 0 tomorrow, the most you will lose is what you pay for the trade, which is those 335. That's the risk of the trade. Okay, cool. Okay, so the trade is valid. Okay, now of course it has a risk of up to $335. So again, if your account is smaller, or you are in initial stages and that's too big, so don't take the trade. The moment I'm finished with this one, I'll try to speed up the light, plan another one. But in the meantime, I want to execute this trade with G using April 29, April 1st, April 29 and April 1st. We were doing 98 and 87. 98 buy, sell, 87, sell. Oh, that was 86. I need to change that. And 87 buy. 87. Here we go. Okay. So April 29, 98, 98 and 87. April 1st, 98 and 87. Sell with April 1st, buy with April 29. The debit is supposed to be 330, which coincides with what we saw. Just to speed it up, please don't do this. Negotiate your entries properly. I'm going to use a market order. Please do not do that. As you know, I'm just doing it just to speed up and get this filled very quickly so I can discuss this trade in future sessions. I got filled at 335. Great. So now I'm going to document those prices on top. Field orders. Here are the prices I got. So I'm going to edit the spread, fill, fill, and again the call side. So we are talking about 236 and 0.41. Okay, 41. Okay, on the put side is 164,024. Okay, so this is the trade, 335. This is the trade. I'm just going to copy and put it on the positions panel so we can review this trade in the future. Okay. And now I'm going to build another one. Okay. And I know I did, especially this last part, very quick, so I can run into another one. Please let me know if that was way too fast and you need me to explain something, especially if you are placing this trading in your account, simulated real money. I mean, obviously, taking it or not, and the size of the trade, real or simulated, all of this is your decision. But if you are doing those actions, and you are confused, please don't be confused. Ask questions. So at least you know what you're doing and what you have in your hands. I know many of you are following this perfectly, but for the ones of you that are newer, or maybe you're watching this recorded and you want to ask questions, make sure you do. And then I'm going to move to plan another one. Let me also document day of the trade, which is here. Okay. Okay, I did it right. Good, perfect. And then the other one, Harley Davidson. That's a $38 stock. You know what? Let's take a look at Harley Davidson just because it's very cheap. So then we can also compare, because G is a $100 stock. So we ended up with an initial risk of $300. If we do a $38 stock, the risk is going to be much less, okay? Which also could be adequate for some of you maybe trading smaller accounts. So let's take a look. So earnings on Harley Davidson happening on April 8th. So that would be April 22nd. Let me see the skew. April 22nd. Where is that? Perfect. Look at that. The red is above the pink. That's great. That's the type of pseudo arbitrage opportunity I was talking about. Okay, so let's take a look. April 22nd and April 1st. This is what we're going to be checking. Okay, now let's go back to the charts. So on that date, see if you know what you're looking for and using top with all the tools and functionalities, putting the trades together, it really takes no time. Sometimes in the sessions I spend a long time to put the trades together, which sometimes I feel I'm helping you a lot to understand, and sometimes I'm feeling that I'm boring you because I could do the trades so much quicker. But at the same time, I just want to make sure you to be able to replicate the processes. Okay, so that's why. Okay, but anyway, so 55. And when the stock is cheap, the problem is that if some of those options are too far, the problem is that we may not get premium enough with the front wick, and then it kind of hurts the possibility of removing risk after a few weeks. Okay, so stocks that are so cheap are not, I'm not such a fan, but again, nothing wrong with it. Okay, so notice that we got more than 2 UFOs above, so I'm going for the next UFOs after the red line. And if I look below, so we have a similar situation we had earlier. Let's take a look at 89-minute time frame. See, I already got 10,000 bars built, so I'm going to just switch to other time frames. Here we go to see if we got data. No data. Okay, so what's the daily telling me? Daily is telling me that the last time we were there was in October 2020, so that was a long time ago. So I'm just gonna do the same action. Okay, I'm just gonna go for the daily time frame. Okay, and out of confirmation, I'm gonna look at the 2-day. Nothing there. The 3-day is worse. Okay, so that's it. That's what I'm gonna do. Okay, and I'm gonna do the same story. So now that I know my range with the purple lines, I'm gonna bring my calculator. I'm gonna look at 46.18 minus the bottom part of the range, 28.66. That's a range of $17. I'm going to divide by 3, and that's $5.89. So $5.89 under 46.20, more or less, is like around 40. Okay, so we are looking at something around 40, somewhere there. Okay, 40, somewhere here. And then the bottom part was 28.69. So 28.69 plus those $5.84 is 34.5, something like that. So let's call it, around 35. Okay, so 35, 34, something like that. What's available on the option chain? Okay, so option chain, you just hit the top of the hour. Okay, so I keep speeding up this. Okay, so 34, 35, and then on the top, what did we say? We said 40, right? Let me double check. Yes, 40. So we have 40 on both expiration dates. All right, pretty okay. 20 cents. Look at that. Not bad. And then we got 34 and 35 in both. Okay, now liquidity here, 0, 0, 0, 0, 0, 0, and you can see the spreads on the front week. 20, 30 cents is fine, but on the other one, 95 to 135, 105 to 65, those spreads are a bit wide. Okay, so I'm not a lover of what I see here, but with patience, you may be able to negotiate that entry, and because you wanna keep the long units all the way to earnings and past earnings. So as long as I get filled in the middle of the spread, we talked about this before. Sometimes you see option chains that look terrible. That one doesn't look good. But because the volume during the day was very little, towards the end of the trading session, next thing you know, the market makers want to get some volume in, and they give you the fill. Now, of course, if you are building a position with 75 contracts, no way you're going to get filled. But if you are practicing this trade, maybe it's 1 contract, maybe it's 5. So next thing you know, now you get filled. Okay, so I'm gonna assume that. Okay, so we are buying the 40. We are selling the 40 on the front wick, and then 25 to 15 with a 35. And yeah, 35 got just a little bit of better liquidity. So I'm gonna go for the 35. My mistake. I clicked in the wrong place, but I could rectify this easily. I'm gonna fix it in a moment in the risk graph. So I am selling the 35, not buying the 35. Here we go. That's it. I got it. So now the stock is cheaper, so the risk is less, 150 in this case. Okay. And again, same story. You have a range, and then if volatility rallies, this is gonna profit for us. Okay. So all looks good. Again, the one thing I'm not happy about this trade is the fact that liquidity is weak. Okay. But if I'm not mistaken, that stock sometimes provide very nice rallies on volatility from 38 to 50 something, from 38 to 60. So if we get an increase of volatility from 47 to let's say it's 15 points, or 20, that would be 67. Let's make it 65. So we are going to be grabbing a lot of profitability with that sort of an increase of volatility. That's pretty nice, right? Given the price of the stock. Okay, and then on top of that, every week, again, you're selling the front week, and basically the potential is to end up with a trade with basically no risk, and making $100+ per contract on a $38 stock. which is quite impressive, I would say. So that I'm okay. So I'd be happy to put the trade in, which I'm going to do right now. Okay, happy to put the trade in. But again, be extremely picky negotiating your entry prices. Do not accept anything just because. Just getting the right strikes. Okay, and I'm going to review these. So we're doing 40 and 35, correct? So 40 and 35, yes. And it's April 22nd and April 22. Oh, I made a mistake here. It's not 29, it's 22nd. Okay, so April 22nd, April 1st, 40, 35, 40, 35. And that produces a debit of 165. So again, same story. I'm going to use market order. Please do not do that, especially on this one. I mean, none of the trades, but especially this one, less than ever. And I'm just going to put it in, so I can just get filled very quickly. Well, when you get these messages on the simulated account, it's because Thinkorswim is trying to simulate market conditions, and it's not going through, and that's a very bad thing. Okay, that's a very bad thing, because that means that simulated market conditions imply that you may not get filled based on available bid size, available ask size, meaning that there is potential for being filled is very, very low. So I just place the order again. I'm not sure if I'm going to get filled or not. I just got filled at 155. Okay, so thank you very much. But again, I think it's going to be very tough to get filled in a real account, but worth it to try as an experience of being filled or not when the stock is not so liquid. Of course, assuming that you want to take the trade. And if you get filled, the beauty is that then it's not a big problem, because then you're just going to be selling the front week and keep the long options all the way until past earnings. So not a problem. It's not like you're going to be stopping yourself out of the trade or anything like that. So then if you get filled at the midpoint, then liquidity is not a concern to me anymore from a critical point of view at all. Okay, so I'm just going to document this in the account. So 110 and 25 for the call. 110 and 25 for the call side. And on the put side, and by the way, while I'm doing that, we are done. Any question, please let me know. 90 cents and 20. Okay. Click OK. That's your 155 trade. I'm just going to copy and put it here in the positions so we can work on this trade in the future sessions. Okay, my friends, we are done. Be waiting just a few moments to see your comments coming in, but we're done. Okay, we are done for today. These lines represent when we took the trade, so when we review this, I make sure we can follow, and I can lead you into the next steps of trade management, which is such an important thing. Very good, everybody. My pleasure. Today I speed up a little bit. Hopefully that was fine. Give me feedback, okay? In either future sessions or emails, whatever. If all is good, then it's good. If all is not good, make sure you let me know. Don't be there, and not saying anything. If there is anything you have to say, again, Josip, myself, the whole team, we're all here to help, okay? So make sure you communicate with us, okay? And if you are new watching this, again, speak up, because many of the members in the community are, more experienced with options trading, or also more used to the way we deliver the sessions. But if you are newer, you may not be, and you may need some reinforcement here or there. So make sure that you let me know, okay? Josip, very nice to hear you're here with us, to see you're here with us, and thank you for the message as well. Very good. Take care, my friends. Bye-bye. See you on the next one. Ciao.